we are back again. Um, and now we've talked about sort of the characteristics and assumptions around financial statements, and all of the rules of financial statements are based on those, and the rules are extensive. When I took my CPA exam many years ago, um, there were about 15 principles that you had to learn, a few hundred pages of documentation. There are now over 100 principles that you have to learn. So the rules are extensive, and they keep getting more and more complicated as financial transactions get more complicated. The rules have to keep up. Those of you who have taken professional exams in other areas, like Coast Guard exams and so forth, know that there's more and more rules all the time. And those people who are getting licenses or certifications have to do that. You may have noticed the letters after my name. I am a CPA, a certified public accountant, which means that I've been certified by taking a national test and then meeting the qualifications of states. So this is a governmentally controlled, CPAs are governmentally certified at the state level, but there's a standard set of national exams that people have to take that each state adopts. And so I was originally certified in Massachusetts. When I moved to Maine, I had to apply and recertify in the state of Maine. So that's the CPA, and what that CPA does is it gives me the right to audit and make an opinion or state an opinion about people's financial statements. Do they comply with GAAP or GAAP, generally accepted accounting principles? Are they stated fairly and accurately? So that's what CPAs do. The certification gives them the right to publicly state that a set of financial statements is in conformity with GAAP and states fairly. The other letters after my name, the CGMA, stands for Chartered Global Management Accountant, and that's an international certification, not government based. It's based from the American Institute of Certified Public Accountants and the British Chartered Accountants Organization, and basically certifies that I have competence in managerial accounting. So those are the two bunches of letters after my name. So the CPA is a government certification. The other one is an independent organizational certification. So we're going to go actually into financial statements, start talking a little bit about how financial statements are, what they are and how they're organized. First thing we're going to talk about is the accounting equation, and all accounting is based off of this equation. So you've got an equation, something equals something. In this case, assets, which we'll define in a second, equal liabilities and equity. So big words, we'll define each one of them. But assets are resources, so the left-hand side of the equation is the resources of the organization. And the right-hand side of the equation is the sources of those resources. Where do they come from, or who has claims on the resources? So assets are items of value owned or controlled by the firm. Liabilities are amounts owed to outsiders, and equity is the firm's owner's claim on assets. So assets, resources owned by the firm. Anything of economic value that can help the firm provide its goods and services to its customers, either directly or indirectly. There are two basic kinds of assets. There are tangible assets, which are things that you can touch. That's what tangible means. So they have physical form. Tangible assets can be anything that you can touch. So the desks and furniture in your office are tangible assets of the firm you work for. The ships and trucks that your firm owns are tangible assets. If your firm is a manufacturing firm, the things that your firm owns in terms of manufacturing assets, machinery, equipment, plants, and so forth are tangible assets. If your firm is in the natural resources business, the oil or coal or natural gas that it owns, even if it's still in the ground, is a tangible asset, something you can touch. Intangible assets also have value, but they don't have physical form. And accounting is weird here. If we develop these intangible assets internally in our organization, so we have, let's say, do research and development and invent something that's patentable, so now we have an intangible asset called a patent, we don't record that as an asset on the balance sheet. If, however, we go out and buy someone else's intellectual property, a patent, what we pay for it does show up on our balance sheet. So this is kind of strange. If you're looking at a balance sheet and a company has developed intangible assets internally, they're not going to show up as an asset on that balance sheet. If they've gone out and bought someone else's asset, it will show up. There's an accounting reason for this, but it does lend itself to some difficulty in interpreting financial statements. This is actually one of the large differences between GAAP accounting, US accounting, and international accounting. International accounting does allow for internally developed assets to intangible assets to show up on the assets of the company, whereas US accounting does not allow for that. The rationale for not allowing it to be on the balance sheet is that, let's say we're a drug company and we have a large research and development operation, spending hundreds of millions of dollars a year on research and development. The problem with recording that research and development as an asset rather than an expense, rather than expensing it in the year we incur it, is we don't know if we're going to develop any new drug for this research. We might, but we might not. We might be going down a dead end and not develop anything. So we want, the US view is we want to be conservative. We don't want to record something as an asset unless it truly has value. And we don't know if it has value when we're expending the money doing the research and development. The European model, or the international model, says, well, research and development is an asset and should be recorded as such. So those two things, that's one of the real disagreements between the international accounting system, IFRS and GAAP. So tangible and intangible, things I can touch and things I can't touch. Goodwill is something that is considered an intangible asset, and goodwill is defined as, if I buy another company, goodwill is the amount that I pay above the tangible assets for the company. What I'm paying for is either the reputation of the company or their customer list or other intangible things that I can't define, but if I paid for it, it must be real. So if I go out and let's say you're running a lawn service company, a landscaping company, and you have lawnmowers and trailers and a shed to store them in, and those are your tangible assets. I buy your company, I'm buying those tangible assets, but I'm also buying your customer list. You're doing $200,000 a year in landscaping revenue. You have good faithful customers, I'm buying not only your tangible assets, but I'm buying these intangibles, the customer list, your reputation, the name of your company, that sort of thing, and I'm paying for it, and I have to account for it, and we call that, when we account for it, we call that goodwill. Companies, your company before you sold it, your landscaping company before you sold it to me, had that same goodwill, but it didn't show up on your balance sheet because you developed it internally. So the only thing on your balance sheet was your tangible assets. When you sold the company, you received more value than tangible assets because you had this thing called goodwill that you developed internally. A little bit confusing. We'll get into it in more depth later. The other side of the accounting equation is liabilities, things that we owe to outsiders, kinds of liabilities you may see on a balance sheet. Accounts payable, that means accounts payable are those things that arise from buying goods and not paying for them when we receive them, paying for them later. So if I buy office supplies from Staples, I may not have to pay for them for 30 days. I have the office supplies today, so they're now an asset if I'm recording supplies as an asset, but I don't have to pay for those goods for 30 days, so I also have an offsetting liability, something I owe. If I borrow money from a bank, we call that a notes payable, because I sign a note with the bank. That's where the word comes from. So I owe this money to the bank. They provided me with cash, and I signed a notes payable, which is the liability. Bonds payable. Bonds payable are long-term, generally long-term liabilities. So I sell bonds to investors to raise money. I now owe the money to those investors, and I have cash. And then there are various kinds of accruals. Payroll is almost always a liability. There's always some payroll or salary liability on a balance sheet because we generally work before we get paid. So I work this week and you pay me next week for the work I did this week. When I work, I'm actually providing value to the firm, so the expense, the payroll expense, takes place this week, but I don't have to pay my employees until next week. And that, in the meanwhile, while I'm waiting to pay them, I have a liability. I owe them the money for something they've already done. Then there are the expenses that also often take place early. So oftentimes I pay for my rent after I've lived somewhere. Usually you pay for utilities after you've used the electricity or the gas. So you don't pay for the utilities before you use it. You pay after we know how much we've used. We don't know how much electricity we're going to use this month, so the electric company bills us later. But we have a liability until we pay the electric company. And then finally, owner's equity. That's what's left. So if you think about your equation, you've got assets equals liability plus equity. So we've got everything we own that has value minus everything we owe to outsiders, and everything that's left belongs to the owner. In a partnership, it's called partner's equity. In a corporation, it's called shareholders or stockholders' equity. In a nonprofit, the same asset exists, or the same, not the same piece of the accounting equation exists, but it doesn't belong to an owner or a partner. So we call it net assets. It's the difference between your assets and your liabilities is net assets. And then book value per share is the stockholders' equity divided by the number of shares outstanding if you're in a corporate environment. So that's your owner's equity. And that, if we go back here, that is your assets equaling liabilities plus equity, stockholders' equity. And in a nonprofit, it would be assets equals liabilities plus net assets. The second part of the accounting equation is the income statement. And this is really part and parcel of the owner's equity portion of the balance sheet, but we state it separately with a separate statement called the income statement. And the income statement is revenue minus expenses equals net income. So that's your equation for your income statement. So revenue, amounts earned by selling goods or services to customers. Pretty simple. Doesn't matter what business we're in. Revenue, I can either sell physical products or services. So Maine Maritime Academy sells education, which is a service. You know, I'm getting paid, you're paying for this course. That becomes revenue for Maine Maritime Academy. Expenses are the cost of providing those goods and services. So you have to pay me in order to provide an education service. So that's an expense for Maine Maritime Academy. So the revenue is the tuition. The expense is paying for the delivery of those services, which includes paying for the instructor. It also includes other costs, paying for this software that we're using and so forth. So that's your accounting equation on the income side, income statement side. In accounting, we record everything using, and here we go back with some more jargon, we record everything using debits and credits. And debits and credits in and of themselves don't mean anything. They're not plus and minus. They, from the Latin roots, mean left and right. So we're working with an equation, and we're working with double entry accounting. So whenever we have a debit recorded, we also have to record a credit. So don't think of these in terms of credit cards and debit cards. Those words get confusing, and actually their root comes from how using a debit or a credit card affects a bank's balances, not your balances. So try to expunge those things from your brain if you can. So let's just think about this. If I acquire cash, if you look at this chart, an increase in an asset is a debit. So to increase cash, I'm going to debit cash. Let's say I acquired that cash by borrowing money from a bank. Well, I've increased my cash, I've also increased my loan or note payable, which is a liability. And to increase a liability, a credit is a plus. So I'm going to debit cash for $1,000, and I'm going to credit notes payable for $1,000. My equation stays in balance because my assets have increased and my liabilities have increased. So the debit is a plus on the asset side of the equation. The debit is a minus on the liability side of the equation, and vice versa for credits. I don't expect you to get this right at this moment, but just understand that that's how the debit and credit process works within accounting. For every debit, there's always a credit, and a debit is a plus to an asset and a minus to a liability, and a credit is the opposite, a minus to an asset and a plus to a liability. It gets a little more confusing, and I definitely don't expect you to understand this at this point. So what we just saw on the last slide is what's across the top here. But stockholders' equity includes common stock, or paid-in capital from outsiders, and retained earnings. That's the money that the company has earned to this point that they haven't paid out to owners, and paid out in the form of dividends. And then, so retained earnings is composed of revenues, expenses, and dividends. So, and understanding the pluses and minuses, the debits, credits here is certainly more confusing. Don't worry about it at this point in time. We'll cover this a little later, and we're just what I'm really trying to do here quickly in the beginning of the course is get you up to speed on some of the basic tenets of accounting. Those of you who had it before, it won't be too bad. Those of you who haven't are probably pulling your hair out already, but we'll get there. Won't take that long. And finally, the last slide here, most of us think in our own personal accounting about cash accounting. So that what's over here on the right, cash accounting. When we receive money, we see it as revenue. So when we get our paycheck, we see that as revenue. When we spend money, we see it as an expense. That's not what GAAP accounting is. GAAP accounting is accrual-based accounting, which means that we recognize the revenue when we earn it, not when we receive it. So I provide you with a product. I ship it to you. I don't expect you to pay me for 60 days, but I earn the revenue as soon as I earned it, which is as soon as I ship the product to you. That's the revenue earning cycle. And then I want to record the expenses for that revenue at the same time as I record the revenue. So all of the costs of that shipment to you, so the product cost and the shipment cost and the packaging cost and the cost of the people in the warehouse and all of that stuff, I want to recognize that at the same time I recognize the revenue. So that's what a financial statement uses. It uses accrual accounting. You personally, when you're, let's say you're selling a car you own, you make the sale and the person says, well, I'll pay you in 30 days. You don't really record that revenue or think of that as revenue until you get the money. You don't think of the expense of your utilities when you're turning on the lights. You think of the expense of your utilities when you pay the electric bill. So accrual accounting is different than cash accounting. All financial statements under GAAP have to be accrual accounting. And all financial statements under IFRS internationally are accrual accounting. So the stuff on the left-hand side here, this is what you're looking at when you look at a financial statement. You're looking at an accrual accounting financial statement, where we recognize revenue when we earn it and we match the expenses to the revenue. That wraps it up for chapter 3. We'll go on to chapter 4 next week. Thanks for listening and answer the questions following this presentation.